Well, the Fed isn't the only one with a dire prediction about the U.S. economy. Former Deputy Treasury Secretary Roger Altman wrote in the Financial Times, quote, "Another recession would be profoundly damaging to labor markets and public confidence. That requires the type of far-sighted leadership that we haven't seen much of lately." Altman is the founder and chairman of Evercore Partners. And Roger, always great to have you on In the Loop.
Hi, Betty.
Am I imagining this or not? You are much more pessimistic than the last time I talked to you.
Well, it's a matter of degree. Until recently, I thought we would avoid another downturn, and we still may. But I'm afraid that the odds of dipping into negative territory on growth have risen to a pretty high level. And I believe the bond market, entirely apart from the Fed's Operation Twist, is signaling that. And all the recent economic data, almost without exception, is so downbeat, whether it's jobless claims, whether it's housing starts, whether it's retail sales, whether it's consumer confidence, they're all trending like this. And so I think we're on the edge of slipping back into negative territory. We may or we may not, but we're right on the edge of it, I think.
But Roger, was there a turning point in these last several weeks or so that told you? I mean, was it a piece of economic data? Was it, what was it about the bond markets exactly that told you this?
It's been the relentless fall in medium and long-term yields.
Okay.
By the way, both on Treasuries, on UK gilts, and on German bunds. Before Operation Twist, the 10-year yield was in the 1.95% area. That was, and we're lower than that this morning.
Right.
That was the lowest yield ever recorded since the Federal Reserve began publishing market data in 1953. Lowest yield ever recorded. Now, ask yourself, well, what does that signal? Some people would say, well, the Fed is on maximum ease, but that controls the very short end of the market, not not the medium and long end. Some would say, well, there's a big safe haven factor going on.
Right.
There's truth in that, but that's not the main reason. The main reason yields are at this really quite incomprehensible level, I think, is that they are signaling that there'll be negligible demand for capital and negligible inflation. And those are hallmarks, unfortunately, of recession.
Of a recession.
Now, I see us right on the edge and at a rather an inflection point. And I obviously hope we don't tip over into the edge.
What could tip us over?
Well, it's a little aversion of a little bit of Franklin Roosevelt's famous comment that all we have to fear is fear itself. Psychology, particularly centering around the European sovereign debt crisis, is extremely negative, and there's a great deal of gloom. You know that because you're following it so closely.
We talk about it every day.
There's a great deal of gloom, and that feeds on itself. And I think that I think the European debt crisis is causing a great deal of retrenchment mentality.
Right.
Among businesses, actually among consumers too. And the consumer sector is the biggest one. We all know that. And I think this is all showing up in the data. We're going to get 3 pieces of data today.
Right.
We'll see what they say, but the recent trend has been relentlessly negative.
Well, given your concern about these long-term rates and the record low levels, now you've got the Fed. They're going to try to push those rates down even lower. Did they do the right thing?
Yes, I think they did, because this is a moment when you have to pull out all the stops, and that's what the Fed has been doing. And despite all the quote controversy over the Bernanke regime at the Fed, I salute him. I think he's been doing time after time after time the right thing, because he's pushing the envelope, and that's what we need.
We are back with Roger Altman, the founder and the chairman of Evercore Partners. And Roger, right before the break, you were saying that you salute Ben Bernanke and what he did with launching Operation Twist. But how do you interpret what's going on with the markets right now? I mean, they're selling off in a major way today.
Yes, but I think the markets are reflecting this edge of recession mentality, Betty.
Okay.
And reacting in part to the very gloomy language which the Fed itself put forward yesterday. I don't think the market is effectively saying we don't like Operation Twist. We think it's a mistake. We don't think it's sound. I don't think they're saying any of that. I think the market thinks it's a good.
The Fed thinks it's pretty bad out there.
Yes, exactly. The Fed thinks things are worse than we thought the Fed thought.
Right.
And that's. It's not important what I think, but that's consistent with what you and I were talking about a minute or two ago in terms of our being on the edge.
Roger, let me talk to you about, obviously, an industry you know very well, banks. Moody's downgraded several banks yesterday, Bank of America, Wells Fargo, basically saying that the too big to fail is over with. There isn't going to be government support any longer for banks. Do you agree with that?
I'm not smart enough to know whether the rating decision was the right one or the wrong one, but as to whether we've moved out of a too big to fail mentality in this country, and if one of these giant banks was on the edge, we would let it go, I don't think so. Now,
so you think there could still be implicit government support?
Yes, I do. It seems to me that the banking sector today is generally much healthier than it was 3 years ago, and in general, most of our largest banks have achieved a pretty full recovery. For example, in contrast to European banks, which in general are much more leveraged, much less liquid, much more at risk. So I think the sector is much...
So the chance of a bank failing has lessened?
Much lower. If there were to be a sudden financial embolism at one of these institutions, and one of them, not the whole sector, but one of them, was seen as potentially failing, I still think that the Treasury and the Fed together would step in to stabilize it.
What makes you say that? What makes you
Because I
convinced
think
about
the impact on the economy and on society as a whole of one of the largest banks failing at this moment of extremely fragile psychology would be terrible. Imagine if all of us heard in the next 24 hours or a week from today or a month from today that XYZ big bank had failed. I mean, a really big one. I think you'd see the economy, which as I described as right on the edge, go just like that. Because consumers would in effect, metaphorically speaking, would hide in their closets. Business would go, oh my God, we're gonna increase our liquidity even further, and it's already extremely high, which by the way is a very bearish sign, because it signifies uncertainty and hesitation. And I just think it would deal a terrible blow to the global economy, not just the United States economy. And I don't think that the authorities would want to see that happen.
So you think if a major bank failed, it would essentially plunge us into recession, and perhaps a global recession?
Yes, I do.
Okay.
And I think all these decisions, of course, have to be made at the time. So I'm referring to a situation where the sector is generally healthy and one institution, in effect an outlier, is teetering or about to topple.
Okay. Roger, great to have you as always.
Thank you, Betty.
Really appreciate you stopping by. Roger Altman, the founder of Evercore Partners.